Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
I haven't talked about it many times. I know that others have probably talked about this with option traders. You are going to, when you first start trading options, you're going to be what we call level 1, level 2 approved by your broker. And until you gain and gather as much experience and knowledge as you possibly can, you're going to find yourself restricted to basic strategies of buying calls, buying puts, buying possibly or selling cash secured puts, debit spreads once you get to the level 3. Once you get to level 4, you're allowed to use credit spreads, sell naked puts, but you need level 5 approval to sell naked calls or do any kind of ratio spreads. And the problem is credit spreads is not that risky of a strategy. It's really a shame that we have it as a level 4. We could do put spreads, we could do call spreads. By definition, we're limiting our risk when we do that. So it should be something that would be available to lower level option traders. But remember, once you start trading, you have your entire lifetime, and you can work yourself up from the lower levels to the higher levels, and then you can participate in the more advanced strategies. So with that in mind, if I'm level 2 approval only, and I'm looking for an opportunity in a market that's in a trading range, I can buy puts near the resistance, I can buy calls near the support. So if I've identified an area where prices are moving sideways for a period of time, that's all I can do, that's what I do. And obviously for that market, for stage 1 and stage 3, very basic strategy, buying puts near resistance, buying calls near support. In this market that you're looking at here from last year on October 21st, we had a situation with the British pound, the dollar pound, and we actually went into a support area between 60 and 63. So on 10/17, I've identified a new potential trading range. And once I've identified the new potential trading range, I have the idea of where I can trade my range and where I can buy my calls and where I can buy my puts. And that's just a basic strategy. As long as I see price staying in that channel and moving back and forth between demand and supply at 60 and 63, nothing wrong with doing that strategy. And as you can see here, first of all, I have a moving average, which is flat, and I have a second moving average, which is also flat. So this is going to be a clear sign that we do have a situation of sideways trading. And sideways trading means, by definition, no trend until either all the resistance up at 63 is absorbed and then we'll break out to the upside, or we come back down and test the support, we finally break through and we start to make new lows. Once we break through here, now we have a trending situation. Now we can do other things. If we happen to have if we buy more than one call and one put with each one of these trades, we have an opportunity to hold a call from the support area in case the breakouts to the upside. We have the opportunity to hold a put to the downside in case the breakouts to the downside. So we have some flexibility if we're good at identifying our ranges in advance. We have the CAD here, which is one of my favorite, dollar CAD. And for many, many months, several times since I've been doing these webinars starting in 2008, we've had pretty much very much sideways action. 9 months of sideways action for swing trading opportunities, for advanced traders to actually do some kind of credit spreads, to do some kind of iron condors, do something to where you're collecting premium in a flat market. We broke out into an uptrend, and almost immediately we went right back into a trading range situation. Another opportunity to where we can use the increased volatility, take advantage of writing calls, writing put spreads. If you're just level 1 again, you can break out, and once you see the market start to go sideways again, buy calls near your trend line support and buy puts near your resistance. Okay? This is not a market strategy for everybody. Don't forget, when you buy an asset, you have the theta risk. You're going to have to worry about time going against you. A lot of people don't like trading ranges. A lot of the students I trade don't have the personality for trading ranges. So they pass on this opportunity. But as option traders that are working towards the goal of advancing ourselves to where we can do advanced strategies, you want to watch these trading range situations. You want to try to trade them either on practice accounts until you develop strategies that work for you. Okay, you select the currency pair that has the support for your bottom of your trading range and the resistance for your top of your trading range. Understand that you may be trading against the primary trend because this sideways action could be just temporarily a pause in an uptrend or a downtrend. So that means take your profits more quickly. If I've been selling off for a while and I start to base, as was the case in this chart here, to where there's a potential for a breakout to the downside, I actually have a slightly bearish opinion on which way the direction is going to go. And even if I do break out to the upside, around 115 in the dollar CAD pair is more resistance that I can lean against and sell, buy puts, or I can actually sell call spreads above that area. So I can have a slightly biased opportunity. And what you want to do is plan your trades on these high time frame charts, especially if you're going to use these options. Always have a stop loss rule. I will use the bottom of a trading range to cut my losses. I'll cut my losses while there's still some kind of time value in the option. And again, just in a couple of weeks, you're going to have an iron condor presentation. And so this is a situation where if you're in a trading range, it's large enough, you have the opportunity to trade condors, pay attention to that webinar and educate yourself with as many of the archives that you have. They have excellent strategies. Now my job here is to help you identify the difference between a trading range and a trending market. So here's our risks on our long positions. Once again, time works against us when we're long. Volatility helps us. So if you take advantage of a real sharp rally for some reason towards the top of your trading range or towards the bottom, then you can sell your options possibly before they expire. The same thing pretty much with your puts. Okay, obviously once you're inside that trading range, you need price to get down to your goal, to your target. If you believe it's going to stall out, if it starts to back out before it actually reaches your target and you have a profit, especially if you're trading against the primary trend, nothing wrong with taking advantage of a volatility spike. And believe me, with all of the events going on in the world these days, to see the dollar jump up really quick, to see the Japanese yen move 3% in a day, take advantage of that volatility. Sell into that strength. Writing strategies have risks. Naked strategies, of course, have risks. Covered strategies by having some kind of spreads, much less risky. Same with your call spreads. So looking at this slide here, neutral on the dollar, expecting reduced volatility. That's the primary definition of a market stuck in a range. There's your iron condor strategy. There's your butterfly strategy. If it looks like for some reason we're spending a lot of time close to the resistance and looking like we want to go higher, now you want to switch to the possibility of a strategy on the dollar with increased volatility, maybe a strangle and a straddle. All right. So once again, once you advance yourself beyond basic levels of options trading, you can move into these more advanced strategies. But this is, again, good stuff for neutral on the dollar.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.